So now we'll talk about the macroeconomic multi-factor models. We've already talked about Pasteur Stambaugh, FEMA French, which you need to know well. Macroeconomic multi-factor models are, so this is a whole category, and as the name implies, these models try to, are basically based, so the issue here is the factors are economic variables that affect the expected future cash flow of companies. Up till now, we have been looking at items that are related to the security markets and then betas that are specific to a given company. So for example, in CAPM, you have the beta multiplied by the equity risk premium. So where did the equity risk premium come from? That was related to the security market. Okay. Now, when we talk about macroeconomic multi-factor model, the factors are macroeconomic variables. Okay. Does everybody, I hope, get that? There are many different multi-factor models. The one example that is given in the curriculum is a BIRR model that's named after the people who came up with this model. In this model, there are 5 factors. I don't think you really need to memorize this model. You just need to know that there is such a thing as macroeconomic multi-factor models, and this is one example. Just to give you a rough sense, so this particular 5-factor model is based on items such as confidence risk, time horizon risk, and so on. Now, these are each factors. So the required return will be equal to the risk-free rate plus these various factors. Actually, this will be the factor that corresponds to confidence risk, and then this will be the sensitivity for a given stock. You can call it, sometimes these are called sensitivities, sometimes these are called betas, and so on. The curriculum gives a description, a short paragraph description of each one of these, but I'll just give you a sense. If you want, you can give it a quick read, but I don't think this is hugely important. You might recall from level 1 that if you look at the economic state of a given country, if the confidence level in how the economy is going to perform, so if the confidence level is high, then the spread between, let's say, corporate bonds and government bonds. Okay, so when the confidence is high, this spread is relatively low, and when the confidence level is low, then what happens? Then the spread becomes high because most money flows out of corporate bonds into government bonds. When money flows out, what happens to the price? Price goes down and the spread goes up. So that's your basics from level 1. Okay, so the confidence risk looks at unexpected changes in these spreads. The time horizon risk looks at the spread between, say, long-term bonds and short-term bonds. Okay, so inflation risk, you can guess what that means. So I think it's worth spending a few minutes just reading these in the curriculum, and that will be good enough. Once you know the various factors for a given economy, those factors will have certain numbers, and then for a given stock, we'll have sensitivity to those factors. Based on that, we come up with the required return. Okay. Next, build-up models. So estimates. So build-up models estimate the required return on an equity investment as the sum of the risk-free rate and a set of risk premiums. So all you say is, here is the expected return on say equity investment. So you say that expected return is the risk-free rate, plus you add equity risk premium, and then you come up with a bunch of other premiums. So here you don't break it up into a sensitivity multiplied by the factor. Here you straight away try to estimate what you will add. So why is this called build up? Because effectively you are starting with the risk-free rate and adding or building up on top of that. Okay. So you notice the second sub-bullet, that like a multi-factor model, but specific beta adjustments, which are the sensitivity adjustments, are not applied in build-up models. The simplest kind of a build-up model is one you might have seen before, where we say the cost of equity. If you recall, one way of coming up with the cost of equity for a given company is to look at the yield to maturity on the debt for that company and just add a risk premium to it. So this is your simplest kind of a build-up model. Okay. Some general points. If you are investing internationally, so you are sitting in America and you are investing in the Thai stock market, okay, stock market in Thailand. What sort of a premium do you apply? There are different issues. One has to do with exchange rate volatility. Okay, the Thai baht might devalue, which will hurt your investment. So that's an issue. Okay, data and model issues in emerging markets. So what model do you use to figure out the future cash flow of companies in Thailand? Okay, so all those are issues. So the larger point is that there are risks associated with international investing. If there is extra risk of investing in a developing country, what do? You add some sort of a risk premium, a country risk premium. There are two broad approaches to coming up with that country risk premium. One is called a country spread model. Another is a country risk rating model. As a general word of caution here, I am just explaining what is in the curriculum right now. You will notice that in different books, and if you work at institutions where there are international investments, there will be models for country risk premiums. Almost everywhere you go, the model will be slightly different. In fact, even between level 1 and level 2, if you recall, in level 1 there was a model on country risk premium that you saw in corporate finance. That model actually seems to me more sophisticated than what you are seeing here. So just take what they've given here as one possible or a couple of possible ways of coming up with country premiums and move on. I don't think this is hugely important. So equity risk premium for a developing country would be the equity risk premium for a developed market, plus you figure out, okay, what's Thailand's country premium or what's Pakistan's country premium. So you add that on to the developed market and move on. The example here is, how did we come up with this? The most simple thing to do is, let's say you are sitting in America and you want to invest in Russia. And this was probably during a time when the Russian economy was not so stable. And you noticed a 13% yield difference between Russian government bonds and US government bonds. So you basically then say that if there is a 4.5% equity risk premium in the developed market, which is the US, all you've done is added that 13% as your country premium. So how did they estimate the country risk premium? Yeah, difference between the Russian bond and the US bond. So this is the simplest. And it's not too bad. For example, if you want to see what's the risk premium for Pakistan, for an American investor, the yield on a Pakistan issued, say, euro bond or dollar bond will be fairly high. I don't know exactly what it is right now, but I'm sure it is much higher than, say, a US 20-year bond. That difference can be a rough proxy for Pakistan's country risk premium. Maybe not exact, but a decent starting point. Okay, so what about this country rating model? Now, all I would say here is this is straight out of the curriculum. I'll read it out and then give my quick comment on this. Country risk rating models, what you can do here is estimate equity risk premiums using a regression based on the empirical relationship between the developed equity market returns and institutional investors' semi-annual risk rating for those markets. So you take developed markets where there are different risk ratings and you create a regression model based on risk rating and equity risk premium, and then you extrapolate, in a sense. You take that regression model and apply it to a developed market where obviously the risk rating will be worse for a developing market. So you take that developing market's risk rating and then say, okay, for this risk rating, what is the appropriate premium to add? Now, The reason I don't think this is hugely important or testable is that the curriculum just spends a couple of paragraphs on it, doesn't give details, doesn't give examples, and doesn't give practice problems at the back. So in my rating scheme, the probability of being tested on this is remote. So just read this in the slides and move on. Okay. Weighted average cost of capital. I'm sure you recall this. When you are estimating the after-tax weighted average required returns for all suppliers of capital, you just take your after-tax cost of debt and multiply it by the market value of debt divided by total market value, which is market value of debt plus market value of equity. And then you take your cost of equity, and the weightage there is the market value of equity divided by market value of debt plus market value of equity. You've seen this in level 1 cost of capital, so nothing new. It's just section 6 in this reading, so it's a quick reminder. Okay, and this is the last point, which is extremely important in general. What is the appropriate discount rate and the relationship between the discount rate you select to the cash flows? Discount rates used for valuation should be consistent with the nature of the cash flows being discounted. If cash flows are those available to all suppliers of capital to the firm, then WACC should be used. Okay, so if you are using free cash flow to firm, the discount rate should be WACC, because here we are considering both debt investors as well as equity investors, and WACC is the cost of capital for all investors. If cash flows are those available to equity holders only, so if we are looking at, say, dividend, which is for equity holders, or free cash flow to equity, then what should we use? Then we should use the cost of equity. When cash flows are in real terms, the discount rate should be real. When cash flows are in nominal terms, then the discount rate should be nominal. Hopefully nothing here surprises you. Okay, so that is it. We've completed this reading.